Hello students, today we are going to practice how to calculate weighted average cost of capital, in particular the cost of common stock. The calculation of cost of debt or cost of preferred stock is not difficult as we discussed in class, but the cost of common stock to we need to calculate the required rate of return based on the capital asset pricing model. The capital asset pricing model has the component of the risk-free rate and the market rate and then beta. So the point is how to get this based on the actual the stock prices, the historical data. So let's get started finding beta. Why it is important to get the beta. The beta is the sensitivity to the market rate. Each individual stock has the sensitivity from the market stock price changes. That determines the required rate of return. Because all the stocks are sharing this RF, the risk-free rate and the market rate, but only the difference is beta. So the first step is historical data from Yahoo Finance website or any other data website. And then choose your company and historical data, set up time period, at least 5 years. Frequency is monthly. At least 5 years, that's enough. Why? We have many frequencies like the 5 years times 12 months, which is 60 months. And then we can understand that the sensitivity. We can accept that sensitivity to the market. And then we will download the Excel for date and the historical data, and they calculate monthly rate of return. The annual rate of return is not suitable. It's not fit for calculating the beta, because we want to measure as frequent as possible, not a daily basis, monthly basis. That includes the 60 months. That's enough. For the monthly rate of return of market, if the stock is if the stock belongs to the market, and then reiterate the same procedures, step 2 and 4 for the stock as well. Okay, and then use the slope function when you measure the beta. So let's get started. I already downloaded the Nasdaq stock prices based on month for 60 months, and then Apple stock. Where did I get it? If you take a look at this Yahoo Finance, there you go. It's for free. You can just apply. As you can see that 5 years, we have 5 years historical prices, and then monthly basis, and apply. Then we get this monthly the stock prices. Then let's download. Then Apple stock price monthly basis is created like this, and then you will use this adjusted closing prices for 60 months. Just copy and paste to our Excel the exercise here, and then we got this all the Apple stock prices historical data monthly basis. And then the Nasdaq, also same procedure. If you type down Nasdaq composite index, then historical data, also the same procedure. You put 5 years historical prices, and then there's this monthly basis, and apply. So we get this monthly, the stock prices of this market. Then let's download. Same procedure. Then do you see from the April 1st, 2016 to 2021. And then adjust the closing prices, just copy and paste to our Excel exercise, and then we got here. Okay. So how to calculate? Let's get started from RF. This RF, we can also found this as long as you type down, for example, for me, I'm going to put 4.25%, the direct input, and I found this information into Y chart. Then the long-term average is 4.25%. I know the 0.02 is not applicable all the historical the treasury bill rate. It's unusual. So usually they have like long-term the average 4.25%, can be higher or can be lower. So we put this long-term the average here. Okay, and then RM. Now the RM is Nasdaq. Nasdaq. We can just find any website here. Also, I found Nasdaq. The composite, like I use the 15 years average that covers like business cycle of a economy. So 10.19%. Okay, let's just use it. As long as you explained where did you get it, and then you can put the harder number there. But you must explain where did you get it. Okay. Then market risk premium. Then what is the market risk premium? Right. Market risk premium is RM minus RF. So 10% minus 4%. So the market risk premium is 5.94. Then let's calculate the beta. In order to put this beta into the market risk premium, and then we get the equity risk premium, which is the RM minus RF times beta. So beta calculation, in order to calculate the beta, which is the sensitivity of the stock to the market, we need to get this monthly rate minus 1. So every month from the last month has been increased like this. So I'm going to drag this down to the bottom so that you get the monthly the rate of return of this Nasdaq. The same way we calculate this monthly rate. You can just double click so that you get this the monthly rate. Okay, then beta. The point of the beta calculation we are using is the slope. Then what is the known y-axis? Always objective is what we want to know. So you need to start always this stock monthly rate of return. Then comma. Now x-axis. When the x-axis moves, what would happen in the y-axis? That is the algebra, right? So we put this area. I should have started from again the y-axis first, which is our objective, comma, and then x-axis, which is the market. Then we got 1.27. This 1.27 is the sensitivity of the Apple stock to the Nasdaq market. When the market increases 10%, then the beta, the Apple stock increased the 12.7%, for example. Then what is the equity risk premium? Equity risk premium, how do you get it? Right, we can just multiple these two, then required rate of return is the RF risk-free rate plus accurate risk premium. So 11.8% is required rate of return of the stock. We are going to use this 11.8% into the calculation of the WACC in the next video clip. Okay? Okay, that's it. See you in the next video clip. You guys, bye-bye.